Well, that recent rally in stocks has come despite a slowdown in profit growth. 80% of big-name U.S. companies have turned in their quarterly numbers, and the results are just so-so, and profit growth is expected to weaken further this year. Suzanne Pratt takes a look at what that could mean for the stock market.
Things been happening on Wall Street this year. Earnings growth has been stumbling, yet stocks have been moving steadily higher. In fact, fourth quarter profits for S&P 500 firms so far are up only 9%. At the start of the quarter, analysts believed they would be 15%. 9% isn't awful, but it's mediocre when you consider S&P 500 earnings growth has averaged 24% in the last 2 years. Earnings expert John Cozy says the problem is firms are running out of ways to slash expenses.
Earnings growth slowdown is more of a result of the fact that companies have squeezed as much as they can out of operating margins. It's harder to get that next quarter's worth of efficiency when you've just cut and made cuts in the past.
In the immediate future, the earnings picture is likely to darken further for corporate America. For the quarter that ends March 31st, profits are only expected to be up 2% from the year before. For Q2, analysts are looking for an 8% gain. So that takes us back to the stock market, which seems to be ignoring the slowdown. Some market pros worry investors will soon wake up to the new earnings reality. Strategist Kaufman disagrees. He says investors are focused on the second half of the year, when profits are expected to improve.
Growth for 2012 into 2013 is expected to be 12%. So that would support a market valuation. Right now, market PE is 13 to 14, which historically is actually low. So it's definitely not overvalued by any stretch of the imagination.
There's no doubt that corporate profits matter to the U.S. stock market. The question is, what matters more, today's earnings or tomorrow's? Suzanne Pratt, Nightly Business Report, New York.